So I think it's about 4 o'clock, so it's time to start. Welcome everybody, those of you who are sitting here at this round table, and those of you who are either listening in or watching wherever in the world you happen to be. It's a new season when it comes to monetary policy. First meeting this year. Marianne Sen and myself will go through the monetary policy report and talk about Swedish economy, what's going on in the rest of the world, what that implies for Swedish monetary policy, the way we look at it presently. Our main conclusion this time was that on the one hand, we see low growth in the Swedish economy, which is not all that surprising if you look at what we said in December, and if you look at the projections, there aren't really any marked differences from our projections. There are minor adjustments here and there. But at the same time, we see some positive signs, and that led us to conclude that this time it was the right thing to stay put and also make very, very minor adjustments to the repo rate path. Given that the repo rate has been halved in the course of last year, and given that we talk about potential interest rate increases first in 2014, monetary policy will stay expansionary, and that will help the Swedish economy, and eventually there will be the economy will bounce back, and we'll get back to something which more looks like normal growth. And normal growth also in our environment implies that inflation will pick up and move towards our 2% target. There are some signs of a turnaround abroad, can be discussed, argued about in many different ways, looking at China, the US and Euro area here, using purchasing managers' index in the manufacturing industry. You can see here that at least according to this measure, there is a clear turnaround. But of course, if you look at the numbers, we're talking about very different numbers if you compare, let's say, Europe and China. But the direction is the same, and that is important at this juncture. I'm not going to go through a number of pictures and talking about what's going on in the financial sector, but the short story is essentially that the numbers look better in terms of interest rate spreads, where stock indices are going, and things like that compared to December. So just from looking at those financial market numbers, one could say that kind of indicates that the nature of the risks that we are talking about have shifted a bit. But major challenges remain. If you look at debt levels, public sector debt, for many years to come, particularly in Southern Europe, countries will have to deal with these issues, and they're somewhat like the issues we had to deal with in the early and in the mid and the late 1990s. And the evolution here is also, if I call it that, is somewhat similar in the sense that first you have a problem, then you end up with a huge problem in the financial sector. Then you struggle through those issues in the financial sector. Once you get a handle on that, so that people are quite convinced that the financial sector is not going to fall apart, it will stay reasonably stable, then you enter into kind of a second phase where you start focusing on all sorts of structural changes that you have to make in the economy, and it takes a number of years to make that happen. Now, in a number of countries in Europe, they're actually on their way towards a better balance than in the past, because let's say Spain and Ireland are moving towards, if they don't already have a current account surplus, and unit labor costs are coming down. So the direction is reasonable. But as we all know, it takes time to make these things happen, and that's why there are still major challenges, and those challenges, of course, will affect aggregate demand in Europe, and given the openness of our economy, that affects us as well. So we still see weak development in the Swedish economy. But eventually growth will come back, and we think that we have the worst behind us. And particularly in the latter part of this year, we think that we'll see growth numbers that are more what we are accustomed to if you take a longer time perspective. And it's not surprising that these numbers are actually fairly close to the blue dotted line, which is the trade weighted index of GDP, the KICS weights here, and of which EMU is around 50%. So as things move on in Europe, that will of course also affect us positively, and over time we'll move into more normal territory, so to speak. One reflection looking at this graph and a number of other ones as well is to say that this time we're not really talking about a cycle which is similar to the very, very dramatic downturn that we had in 07, 08, 09, and 10. This is something which more looks like the things were in the early 2000s, and that in itself is actually a good thing. And we also have domestically some positive signs. If you look at business confidence indicators and the household confidence indicators, they have an uptick. Still on the low side, but the direction is the right one, so to speak, when it comes to looking into the future. But unemployment will rise during the year, and that's because unemployment usually is late in the cycle. And that means that will be the unemployment level this year will stay above 8%, but then gradually, as demand picks up in the Swedish economy, then unemployment will gradually come down towards a lower level. Of course, one issue that we discuss in the report here, and this is a serious issue and a difficult topic, that's how to distinguish between what is structural adjustment or structural phenomena in the labor market and what is just purely cyclical. And it's not always so easy to make that distinction, and we have also some examples and calculations in chapter 2 where we go through what happens in terms of monetary policy and how different the outcomes can be depending on what's going on in the labor market. And the inflation rises towards the target over time. Looking at the CPI, once the policy rate starts moving up and once aggregate demand picks up both domestically and abroad, that will lead to higher wage increases and then also price increases, so that eventually we get to our target around early 2014, around 2%. And then we of course have the traditional overshooting in the CPI. Once the repo rate goes up. And here, this is what we think is reasonable and necessary to do when it comes to attain our inflation target in order to support the economy. Looking at these two graphs, the dotted lines are fairly close to each other. Basically, what we say this time is that the highest probability is no change. And then there is a higher probability of a cut than a hike. But to stay put, that's most likely. That's how this reads. And we find this reasonable because the repo rate has been halved since last winter, and this will add to aggregate demand so that we reach our inflation target. And it takes a while before this will happen, before we get the full impact of monetary policy. And still, everything that we do is against the backdrop of continued large debts in the household sector, and that's not likely to change overnight. But at least this time around, the debt level seems to stay fairly stable, and that's probably a good thing all in itself. Now, as always, it's a forecast, it's not a promise. And if things turn out to be better, perhaps because things turn around faster in Europe, then that adds to aggregate demand here at home, and inflation will go up sooner rather than later. And that, of course, means that interest rate hikes will follow also sooner than what we have expected here. While on the other hand, if the labor market were to be weaker than we expect and inflation would be lower than we expect, then that would either push down the interest rate or push rate hikes further into the future. But nonetheless, the path that we have there in the middle, the forecast, that's our best estimate, our best forecast as of now. Now, Marianne will say a few words about some other parts of the report. Marianne.
Okay, thank you. So there's an article in the policy report about the balance sheet of the household sector, and I'm just going to go through it very, very quickly in 4 slides. And well, the background is perhaps obvious that the household balance sheet is a very important variable to keep track of. It's both when in our ordinary, when we make our economic projections, but increasingly so when we think more and more about risks to the future. When it comes to making our sort of ordinary economic projections, our baseline scenarios, we know that asset price movements, they will affect consumption decisions through the wealth effect. And since balance sheets have grown very much in the past 10, 15 years, these effects have been increasingly important to keep track of. But also, as the financial crisis has taught us, it's very important to think about risks and vulnerabilities, because if these play out, they can have very serious consequences for economic growth and for unemployment. As you all know, this is a very active area of research, and many central banks are trying to come up with good and proper analytical tools to use, and we're trying to fit this into a monetary policy context, how to take into account these risks. As you know, this is work in progress. We're all struggling a bit, but this article is an attempt to start this discussion, and we talk a little bit about data, and we end off with a very, very simple example, but nonetheless an example of the type of analysis that we will need to elaborate on, become better at in the future. So let me first start by talking about the data. And since there is no regularly published official data on household balance sheets, we have to compile that ourselves. So the article starts off by just going through how we do that. And this is the result. So this is a time series of Swedish household balance sheet. The top gray line is total wealth. It's grown rapidly in the past 15 to 20 years, and it's now at 5 times disposable income. All of these lines are expressed in terms of in percent of disposable income. So total wealth is comprised of 2 asset classes: real wealth and financial wealth. And real wealth, that's the yellow line. That's housing. And whereas financial assets, it's a range of different asset classes, from very, very liquid banknotes, bank deposits, to more illiquid financial asset classes. And but adding the yellow and the blue together, you get total wealth, the gray line. So total wealth has grown very much in the past 15 years, and as you can see, this is mostly due perhaps to real wealth increasing, simply a reflection of the fact that house prices have risen by quite a large amount in the past 10 to 15 years. To make the balance sheet complete, we also need to look at the right-hand side, and you have there the yellow line showing the debts of Swedish households, debts which are used to finance the real wealth, the housing. So that's a picture of how household wealth has grown. Now, most of the variation in wealth is perhaps due to variations in financial wealth, and this is something we need to keep a track of when we make our forecasts. And in particular, we need to keep a track of how net assets evolve. So that's the blue line in this graph. They have grown since total wealth has grown more than debts, so net assets have grown over time. Net assets also vary a lot, and this is due to variations in financial and real asset prices as well. Debt, of course, doesn't vary as much. So the variations in net assets is due to financial prices. What you can see then here in the graph is just an illustration of the fact that there is a clear wealth effect in the data. So when asset prices rise, people will tend to take that into their consumption decisions and increase their consumption. Conversely, draw down on their savings. The red line is own total savings in the economy. And of course, these types of effects then are something that we take into consideration when we make our forecasts. So this means that we have to make forecasts of asset prices when we make our consumption forecasts, and we sort of take average effects of variations in financial prices and how that works out into the consumption decision and consumption forecasts. But there are risks too, risks also, as I said in the beginning. And we need to think more about vulnerabilities and what can happen, what if scenarios. And I'm just going to end by talking about a very simple example that we have in the article. And we just talk about, so what could happen if house prices fall by say 10%? And well, I've called it a benign scenario and a malign scenario. Don't take this too seriously. I mean, a favorable or less favorable. But starting with a more benign scenario, it just goes to illustrate, talks about the situation when if house prices fall, people can either take from their financial wealth to if they want to restore their LTV ratios, they can take that out of financial assets that they have. In the benign scenario, there will be most likely rather small or normal effects rather on consumption. So these are the types of effects that we have on that we are rather good at predicting, so to speak. But there are more malign scenarios. And if for some reasons households must increase their savings because for some reasons they must restore their loan-to-value ratios, either because they decide to do that themselves or they for some reason have to, then and they have to amortize on their debts, then the consequences for consumption can be quite dramatic. And the example in the box just makes a calculation that in the current situation that if house prices were to fall by 10% and Swedish households wanted to return... If you wish to remain in conference, please press any key now. And they want to restore the loan-to-value ratio, then debts would have to be decreased by approximately 300 billion Swedish kronor, which is 17% of disposable income. And obviously that could have rather large effects on consumption and economic growth in Sweden for a long time. So this is just a very simple example, but it's an illustration of the type of scenarios, risks, and vulnerabilities that we will try to develop methods for addressing these issues, and we'll keep you informed as we go along how we make progress on these types of questions.
Okie doke. So all in all, growth is presently, as I started out saying, on the low side. Growth will pick up in the course of the year, given the low policy rate, and the low policy rate will stay at this level into 2014. Eventually, growth will come back towards the latter part of this year, and at the same time, risks compared to what we talked about in December have shifted a bit because we see some positive signs. So that's where we are now. Questions, reflections on this or any other stuff that's in the long report. So, please.
You have just published a business service that you do regularly from the Riksbank. What's your conclusion of the results in that business survey, and how do you weigh that into a repo rate decision or monetary policy framework?
Okay. So the business service, we publish these 3 times per year, and there was one that came out I guess it was a few weeks ago. It was a survey that was conducted at the beginning of this year, and this is of course information that we use in our forecasting, definitely. And I think it told us had a sort of the same message that other types of surveys conducted by, for example, the National Institute, the same type of message, namely that we have growth is very, very weak right now, but there are some positive signs. But the situation now is very, very dire, very, very difficult, in particular for the manufacturing industry. There are very, very many manufacturing industries represented in that business survey. But to answer your question, we use that together with, it's one piece of the puzzle, so to speak.
More questions, reflections, or everything is crystal clear? That would be remarkable.
Well, one question then connected to that. You mentioned that the manufacturing survey has a very difficult time right now. And one factor beyond weak demand from the European market particularly is the strengthening of the Swedish krona. And it has continued to strengthen at the beginning of this year. How do you view that, and what do you expect the manufacturing industry to can they manage the appreciation of the krona?
Yeah, if you take a look at the exchange rate, and if you take a longer time perspective, setting aside the past few months, and if you look at our projection, basically what we say is that it's going to roughly stay flat. If you look at the nominal exchange rate, which we have here, which is a quite traditional projection. But if you look at the real exchange rate over time, and here this thing goes all the way back to '98, you can see that this is not a major thing, and that's of course because in our case inflation has been low and lower than in many other places, and that's why it looks this way. And we find this given what's going on in the Swedish economy, given what has by now actually been going on for quite some time, when we have had and still continue to have a very large current account surplus. This is roughly, in our view, what one would expect.
The structural change in the Swedish economy will continue with less employed in the manufacturing sector, and then the
well, I mean that's of course always part of this process. Then in this you have to factor in a certain degree of structural change, which is and then of course in addition an issue in itself when we get back to these other reflections on the functioning of the labor market and how you deal with the structural issues on that side. But I mean, we have an inflation target, and we set the policy rate, and then the exchange rate ends up where it is.
You elaborate, which is very interesting, about the structural level of the unemployment rate. But if you have a quite broad interval currently at 5 to 7.5%, I think. If you take the midpoint of that, you reach that level roughly if I remember right in your graph here, sometime in 2016. Is monetary policy then well balanced until then, or what's a reasonable time frame to reach a potential level? 2016 is ahead of the normal forecast horizon, I guess. Or can you elaborate a bit?
Well, the issue is what monetary policy can do and what monetary policy cannot do, and within what time frame and how we think about inflation at the same time. And given that we have our 2% inflation target and that there is a trade-off there, this is what we get when we sort of think about what is likely to happen here, given the projections at this juncture.
But you could say that unemployment.
Something there, because I guess what you're thinking about is if we have a flexible inflation targeting regime, which means that we look at inflation, but we take into consideration the real economy. But it's important to keep in mind here that there's not a single measure of real stability that is used by the executive board when they look at the projections and they form their opinions. Other measure, with your line of reasoning, you're saying that the gap is not closed, but that is not sort of the way that the discussion is conducted. There are other. We have a range of measures. And they are looked at as a collective, and then at the end of the day, the executive board has to sort of come to some kind of conclusion. Mm-hmm.
Even though unemployment gap is of course quite what should I say in English, heavy. It's important, I guess, since it's quite an accurate measure of the slack in the economy, don't you think?
Well, one can argue about that, but because at the same time we have these structural issues, and our impression, and we've written and argued about this in other reports earlier, is that the structural unemployment seems to have gone up, and it's hard for us to deal with that part of unemployment, and particularly if you look at different groups of unemployed, it's quite clear actually that people who kind of belong to some kind of an average individual in the labor market, things haven't changed all that much there. While on the other hand, you have groups that are quite different, and seem to be very hard to employ, and that means that you have the kind of a divergence within the labor force in itself, and that's hard for monetary policy to deal with.
What you're saying is that in the short term, it might be that the naira is on the upper part of the.
I mean, this is one reason for why we don't pin this down to a number. This is exactly why we're talking about this in terms of an interval, because it's pretty hard to, in real time, fully understand where we are and what's going on in the system. And particularly, we have always taken the view that if I use the concept of naira is actually moving around over time.
And that was interesting, as you said, because it's time dependent. Because when you say structural shift, when you show with beverage curves, for example, then you mean the current level of naira. You don't assume that the steady state rate of unemployment has changed, do you? If you understand what I mean. The long-term equilibrium.
Okay, you're getting
into
you're getting into details, which there is. Let's put it this way: there's not a 100% consensus of how to talk about these issues. Not in the literature, and not at the monetary policy department of the Riksbank, nor in the executive board. There are a lot of concepts out there. We prefer to talk about long-run unemployment, and as was just mentioned, we've identified a range. It's quite large. It's from 5% to 7.5%, and that's a reflection of the uncertainty that we have in pinning this down. Now, when we use our models, we can't put in a range. We have to put in a number. So we put in the middle. But as a scenario in chapter 2 goes through, it goes through an example of when that midpoint is actually where 6.25 is not a proper representation of long-run equilibrium unemployment.
I think you had an interesting picture depicting the savings rate and the net assets. Could you just? It seems to me that there is no correlation at all between 1980 and 1987 or so, and then there is a positive correlation between 2006 and till now, and then you have this negative correlation in the period in between. Isn't that a little bit too unstable to draw any conclusions from?
Yeah, I mean, these things are always difficult to do, but and this is why this stuff is so hard to deal with, because on the one hand, it's hard to judge in a short time frame. On the other hand, history tells us if you borrow too much, you end up with a problem. And that's well known in a very large number of countries, including our own. The last time around, it wasn't the households, it was the corporate sector. And that created all sorts of difficulties. And we do know, if you look at, for example, what has happened to households in some other countries, when they run into difficulties, it takes years to get out of that. And that's the hard part. That's the hard part of it, to pass these judgments. But as a general rule, the more you borrow, the more dangerous it gets. And the reason for it is not that strange, because you can say on the one hand, wealth has gone up, but you pay out of your current income, and that's why you have this effect that everybody can't sell everything at the same time, and you can't either move. So if too many have borrowed too much, it's just going to take a while to de-lever. And that's a painful process, and it takes many years. And ideally, one would like to avoid ending up having to deal with that. While at the same time, the hard part is to kind of put numbers on these things, because this is very difficult, at least at this stage of technical development, to include in models when we do the projections, and that's why a good part of this conversation actually takes place outside the models as such. But by observing what has happened in other countries, we do know that if you end up with a problem here, then you have a problem to deal with for a considerable period of time.
I share your conclusion, but I don't think that illustration is very good, because it's. But that's more technical. A similar observation is that, I mean, these PMIs are extremely volatile. They have been actually mirror image of what's happening in the European banking system for the last couple of years. So perhaps we should be a little bit. What you're actually are doing is to make a bet on that we will not see any more banking problems in Europe. And I mean that's a fairly good guess, but I think that's actually what we're seeing here. So if we see new problems in the Spanish banks, then these.
But let me comment on that. In various parts of Europe, in various countries, people have struggled with banking problems by now for 5 years. And at the same time, the ECB has put more and more money into the system, and more, if I call it technical measures, have presented themselves or kind of emerged over time. And that has produced an environment where, on the one hand, in my view, it's quite unlikely that you would all of a sudden, out of the blue, have kind of a major accident in the financial sector in Europe. That's not likely to happen. Then that would probably be known then, or already, or it would have happened. And there is enough liquidity in the system in one way or the other to deal with whatever liquidity issues might be around the corner. So in that sense, the comfort level today is higher than it has been in the past. And if you take Irish banks, if you take Spanish banks, if you take Dutch banks, Belgian banks, they have done a good part of their homework. Whether they've done everything they have to do, I'm too far north to pass judgment on that, because then you have to sit right in it yourself. On the other hand, there are still some remaining issues, of course, in the European banking sector, because there will be a process of deleveraging that will have to continue in one way or the other. But part of that, in my view, we catch when we have a very low growth projection for the euro area, because part of the low growth comes from the fact that if you don't do the restructuring, or it will take time to do the leveraging, the recapitalizations, all these technical things that you normally have to do, then of course there will be a low supply of credit, and that of course does something as well when it comes to what happens to growth. So again, two different phases here. One is what's behind us and in the very, very short run, and that has, in my view, largely been taken care of. But then eventually a different banking sector will have to emerge out of all of this in Europe, and then there's probably still some homework to be done on that side. But that's kind of compatible with our growth projection.
I mean, we have negative growth for 2013, and it only crawls up to 2% in 3 years' time. So it's not an optimistic or rosy picture that we paint.
Your projection just concluded that these PMIs are more or less reflections of what's happening in the financial system.
Sure. Can I ask you something more about that savings and debt? As you say, it poses risks ahead. At the same time, you say that currently, or for the period ahead, we need an expansionary monetary policy in order to attain our inflation target and keep up demand. But expansionary policy, isn't that you want consumers to wish consumption earlier in time? And isn't that more or less the same as wanting savings to go down? Or
well, that's one
do
of
you
the
understand?
okay. Well, that's one of the perennial issues here, and one of the trade-offs and one of the struggles. And let me take a longer term view and tell you a different story, which I had in a speech some time ago, and which is, by the way, not at all in the monetary policy report, to be clear about that. When you in the past, if you go way back when we had a fixed exchange rate, then that was how you defined monetary policy. Each time you had to expand aggregate demand, you had to do it through fiscal policy. Each time that happened, debt went up. And over time, we accumulated so much debt so that it became an issue. And then we had to struggle with that for 10 years to get the debt level to go down. And that was done in combination with putting in place all sorts of rules trying to avoid that in the future. And then we move into a different regime, and we say, okay, now we have a floating exchange rate. We have fixed the fiscal, and we have an inflation target, and the central bank is dealing with moving the policy rate up and down to deal with aggregate demand. At the same time, given that the inflation rate comes down, it becomes easier to borrow, and just for this, again, for the sake of the argument, if you run through that policy time and again, and each time you want to expand aggregate demand via the transmission mechanism, it has to come through increasing debt. If that debt never goes down, eventually you have these trade-offs which are not that
If you wish to remain in
which are not that dissimilar from the earlier issue we had with government debt. Now the difference being, then it was the government, now it's the household sector, maybe in the future it's somebody else's debt. So,
but that implies that we can not only have an inflation target, that is. It means that if we track the inflation target, then we must accumulate more and more debt.
Now it still works. It can still work, but one still has to keep an eye on the debt levels, because if something gets too unbalanced on that side, because we one way or the other have created too much leverage in the system, then that eventually at a future date could end up being a kind of a constraint that puts limits on what you can do or cannot do in that particular sector. Now, the way to deal with that when people argue about these things nowadays is to say that if the policy rate cannot handle everything, then basically what you deal with is these things you call macroprudential. I'm talking about loan-to-value ratios and all sorts of other measures that you use in order to confine the restrictions to a certain sector of society. And in that sense, if you take the long view, we tried that in the 60s, 70s, and 80s, so it's not new. It has happened. It had happened before, but then we just call these things different names. But essentially, it's just saying that nothing comes for free. There are always trade-offs when you do these things, but the trade-offs differ depending on what kind of monetary policy regime you actually use. Well, that was a long, a long answer to a question. Okay, more questions, reflections? If not, anybody listening in who would like to ask a question? Nope.
Okay.
Yeah, sure.
Okay. Would you say that a 25 basis point shift differs in expansion narrative from, say, 1%, or if you start from 3%? Is it the same difference between 3 and 2.75 as 1 and 0.75%? It's very common in the debate, I think, that many people say that at these levels, perhaps a rate cut doesn't affect that much as it did at higher rates. Is it any non-linearity, would you say, in repo rate changes?
Let me give it a try, and Marianne, then you can fill in or correct me.
Yeah.
I think that part of the answer depends on to what extent the transmission mechanism in the country in question is reasonably intact or not. Because if the transmission mechanism kind of works the way it is supposed to work, then it matters much, much less. But if it is not, because you have all sorts of issues in the financial sector, or if you have ended up in a position where either the banks have problems so that they are busy dealing with their own problems regardless of how much money they can borrow from the central bank, or certain sectors in society have come to the conclusion that they are over-levered. So they focus on not they focus not on borrowing more, but actually borrowing less because they're not happy with their long-term leverage, because they're over-levered. Under those conditions, then it becomes much more difficult, because then what happens is that you can put more and more money into the system, either via the policy rate or through other measures, and the effect, or the bang for the buck, so to speak, will be less compared to if you start in some kind of an equilibrium where you say, okay, now things are really very, very close to normal in terms of household behavior, corporate sector behavior, bank capitalization, and things like that. But then these are more kind of verbal reflections to really measure these things. That's up to the historians to deal with for many, many years to come.
So let me just add some, let's call it technical aspects. I mean, in the models that we use, there are no non-linearities. So for example, the interest rate scenarios that we have in Chapter 2, that's sort of independent of the level of the interest rate. So that's a model. That's what the models tell us. Then, of course, when this is brought into policy, you have to add all the aspects that Stefan just went through, and And then at the end of the day, it's up to each member of the board to assess how they think that monetary policy right now, what the impact is. And it can vary over time. If you look through the minutes, you will see individuals saying that right now monetary policy changes will not have as large an impact as usual, and things like that.
Okay, thank you very much. Thank you very much for coming, and thank you for many good questions, and thank you to all of you who have been listening in or watching.